Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a 1-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA, and I've left my lines on the chart from last week's report where, as you can see here, I drew a diagonal line representing the anticipated drop in the market to fill this gap point right here. Now, the angle of that down leg was drawn in a conservative way. As you could see, the market went through a much more aggressive sell-off, and you can see here now that the volume is increasing. So let me erase these lines right now, and I'll draw my forecast for next week. As you can see right here, this low represents the most current level of support. So I think that we could very well drop just a little bit more and test that level of support and then possibly get that bounce. So I'm going to leave that in there again with conservative angles for those who are trading using my numbers and using the support resistance levels. Again, technical analysis is not difficult if you learn how to read the signs. The other thing that I brought up last week with regard to this gap here is that 80% of the gaps that form eventually fill. So you could see that the gap filled right at this point, but in the process of this aggressive sell-off, we also left another gap above the market. So this becomes a new target. Once this pivot point has formed, we have to then monitor the volume and see whether or not the buyers have enough strength to bring it back up to that point. So I'm going to label that as my resistance point, because the second part of that equation is once a gap fills, there's an 80% chance that the price will reverse from that point and go the other way. So that's the diamonds. Looking at the spiders, this is the S&P 500 ETF. You can see that again, I left my lines in place. This line above here was the established resistance point. I absolutely identified that, and that line is in place. And you can see how we pulled back from that resistance and followed along with my down leg perfectly to fill this gap once again. So I think it's safe to erase these lines as well, and I'm going to draw the new support level down here. The S&P has a little bit more ways to go, so I think we'll see a little bit of a down move before we start to test this level of support. The thing that catches my attention here is that the volume is still increasing on the down leg. So the sellers are still in force with no gaps above the market. So keep your stops in place, watch out below, and make sure you're using good risk management disciplines to protect any profits. Looking at a more broad-based index, you can see that the Russell 2000, again, followed my line perfectly with the anticipated sell-off reaching this trend line. But the most negative thing that we see about this chart is that we have a breach or a breakout of that trend line. So this really is a game changer here. For anyone who follows technical analysis, you'll know that this breach really changes the game, and it could lead to a head and shoulders top, which becomes much more bearish for the general markets. Remember, the Russell 2000 carries a lot more weight than the Dow and even the S&P. So watch out below. I'm going to draw another line where I think the Russell 2000 could go a little bit lower. So I'll erase this line from last week, and I'll leave this one in place because I think that we could still see lower prices there. Looking at the Qs, this is the QQQ, or the power shares representing the tech sector. You'll see that we're batting 1,000 here with my forecast, 100% accuracy, and that the market followed my trend line from last week, and we are absolutely at a role reversal support level right here. So I think the NASDAQ might actually drop a bit more, but then eventually bounce off of this support level right here. So I'm going to just leave this in place. We have to see whether or not the support level holds, because there's still a gap below the market. I'll remove that line so you can see that more clearly. This gap could very well result in lower prices here and then maybe a bounce from here. So again, keep an eye on this because things are looking very bearish right across the board. Now finally, the VIX. This is the leading indicator that I talked about, and I continue to follow this as such. I did forecast the bounce on the VIX off this support level, and yes, in fact, that's what happened. I think the VIX will continue to rise to fill this gap point right here, and then we could anticipate a reversal in that and see the VIX go lower. Remember, the VIX is a contrarian indicator, which is why I use this as a leading indicator, because when the VIX goes up, market goes down, and vice versa, especially the S&P. So keep an eye on the VIX. There's a lot going on here with volatility, and I continue to report on this each and every week. Now, finally, make sure you're following the Market Guys on Twitter. You just go to @TheOptionsOracle. I continue to post relevant information that has to do with the market, particularly option trading, and also charts. Yeah, some other pictures in there that are a little bit more motivational in nature, but you can see that I did forecast Apple sell-off quite nicely. I did also forecast a slight bounce in Apple, so my percentages of accuracy are extremely high, and I continue to report that and give that part out to the general public for free. Now, when you go to themarketguys.com, you can click on the video tab right there, and it will bring you to a library of educational videos. Again, we do this for free to more or less educate the public on how to manage risk and how to identify the signals. And as you become more fluent in these concepts, you will most likely develop some skills that will increase your confidence level and in turn improve on your profits. So right now, the Market Guys is in full-fledged educational mode, and we really enjoy what we do with regard to educating the public on investing and trading. So have a great weekend, and we'll speak with you soon. So long.